It's 2001. Enron is one of the most admired companies in America. Fortune magazine has named it America's most innovative companies 6 years in a row. The stock is trading near its all-time high. Wall Street analysts are falling over themselves to recommend it. The CEO is on magazine covers. The company's market cap is north of $60 billion. And a small hedge fund in Houston is betting everything that it's all a lie. The fund is called Kinnikos Associates. The manager is a guy named Jim Chanos. And while everyone else is buying Enron stock, Chanos is doing the opposite. He's borrowing shares and selling them, planning to buy them back later at a lower price when the whole thing collapses. Chanos had read Enron's financial statements. Actually read them. Not the press releases, not the analyst summaries, the actual filings. And what he found didn't make sense. The company was reporting enormous profits, but generating almost no cash. The accounting was labyrinthine and opaque. Nobody could explain where the money was actually coming from. In December 2001, Enron filed for the largest bankruptcy in American history up to that point. The stock went to essentially zero. Jim Chanos made hundreds of millions of dollars, not by finding a great company, by finding a fraud and betting it would collapse. That is short selling, and it is one of the most controversial, least understood, and, I'd argue, most important mechanisms in financial markets. So how does it actually work? Because the mechanics are a little counterintuitive. Normal investing is simple. You buy something, you hope it goes up, you sell it for more. Buy low, sell high. Everyone understands that direction. Short selling runs it in reverse. You sell first, then buy later. Here's how. You think a company's stock is overvalued. Right now it's trading at $100. You believe it should be worth $40. You go to your broker. Your broker finds someone who already owns shares, a pension fund, a mutual fund, some long-term holder who doesn't plan to sell anytime soon. You borrow their shares. You pay a small lending fee. You now have the shares temporarily. You immediately sell those borrowed shares on the market, $100 each, cash in hand. Now you wait. If you're right and the stock falls to $40, you buy shares on the open market for $40 and return them to the person you borrowed from. You sold at $100, bought at $40. You pocket the $60 difference minus fees. If you're wrong and the stock rises to $160, you still have to give back those shares. You have to buy them at $160 to return them. You sold at $100, bought at $160. You lost $60 per share. That's the basic trade. Borrow, sell, wait, buy back, return. And now, here's the thing that makes short selling uniquely terrifying as a trade. When you buy a stock normally, when you go long, your maximum possible loss is 100%. The company goes to zero, you lose what you put in. That's bad, but it's bounded. When you short a stock, your maximum possible loss is theoretically unlimited. If you short a stock at $100 and it goes to $200, you've lost $100 per share. If it goes to $500, you've lost $400. If it goes to $1,000, which sounds insane until you remember that stocks have done this, you've lost $900 per share. The loss keeps growing as long as the stock keeps rising, and a stock can, in theory, rise forever. This is why short selling requires not just conviction, but nerves. You can be completely right about a company being a fraud and still lose everything if the stock keeps going up before it comes down. The market can stay irrational longer than you can stay solvent, as Keynes once put it, and it was basically written for short sellers. There's a specific nightmare that short sellers have, and it has a name: the short squeeze. Here's what happens. A lot of people have shorted a stock. Let's say 30% of all available shares are borrowed and sold short. The stock starts rising for whatever reason. Maybe it's just random. Maybe someone starts a rumor. Maybe retail investors on a forum decide to buy it en masse. As the stock rises, short sellers start losing money. At some point, many of them panic and decide to cut their losses. To close their position, they have to buy shares. Buying shares pushes the price up further, which panics more short sellers, who buy more shares, which pushes the price up more. This feedback loop can send a stock vertical in days or hours. Short sellers who were right about the fundamentals, who correctly identified a mediocre or even fraudulent company, still get destroyed because of the mechanics of the squeeze. You probably know the most famous recent example: GameStop, January 2021. GameStop was a struggling brick-and-mortar video game retailer in a world that had moved to digital downloads. Fundamentally, it was probably worth very little. Hedge funds had shorted it heavily. Then, retail investors on Reddit, a community called Wall Street Bets, noticed the short interest and started buying. Aggressively, coordinated, gleefully. GameStop went from around $20 to nearly $500 in 2 weeks. Some of the hedge funds that shorted it lost billions. One, Melvin Capital, lost 53% of its value in January alone. It eventually shut down. The Reddit traders weren't necessarily wrong about GameStop's fundamentals being bad. They mostly weren't even trying to make a fundamental argument. They were intentionally squeezing the shorts, and it worked. Short sellers tend to be the most hated people in finance. Companies hate them, obviously. If someone is publicly betting your stock will fall, they're often simultaneously publishing research explaining why, which can accelerate the very decline they're predicting. CEOs call them parasites, manipulators, enemies of capitalism. Regulators have repeatedly tried to ban or restrict short selling. During the 2008 financial crisis, the SEC temporarily banned short selling on financial stocks, blaming shorts for accelerating the collapse of banks. And regular investors often find it morally uncomfortable. There's something that feels wrong about profiting from a company's failure, from people losing jobs, from shareholders losing savings. Short sellers look like they're cheering for bad things to happen. But here's the case for them, and I think it's pretty compelling. Short sellers are, in practice, the people who do the detective work on fraud. Enron, WorldCom, Lehman Brothers, Wirecard, a German payments company that turned out to have 1.9 billion euros in cash that simply didn't exist. In almost every major corporate fraud of the last 30 years, there was a short seller who figured it out first, published research, was viciously attacked by the company and its defenders, and was eventually proven right. They have an enormous financial incentive to find the truth. If a stock is a fraud and you're short, every dollar it falls is money in your pocket. So, short sellers read filings in obsessive detail, hire investigators, talk to former employees, cross-reference footnotes. They do the work that auditors should do but often don't. Without short sellers, overvalued stocks stay overvalued longer. Frauds survive longer. The price discovery mechanism, the process by which markets figure out what things are actually worth, works worse. And prices being wrong has costs. Real ones. When Enron's stock was inflated at $90, that capital was tied up in a fraud instead of going to real companies doing real things. When housing assets were mispriced in 2007, that mispricing enabled the lending that caused the financial crisis. Getting prices right isn't an abstract exercise. It determines where capital flows in the economy. Short sellers, whatever you think of them personally, help keep prices honest. There's a quote I keep coming back to, from the investor Charlie Munger, Warren Buffett's partner, one of the wisest people ever to have an opinion about markets. He said something like, "Show me the incentive, and I'll show you the outcome." Every other participant in financial markets has an incentive to be optimistic. The broker gets paid on trades. The analyst works for a bank that wants to do deals with the company. The CEO has stock options. The media wants access. The short seller is the only person in the room whose incentive is to find out what's actually wrong. That doesn't make them right. It doesn't make them noble. It makes them useful. Jim Chanos is still running Kynikos Associates. The name, fittingly, comes from the Greek word for cynic. In ancient Greece, the cynics were philosophers who believed in stripping away pretense to find the truth. They were widely considered obnoxious. They made powerful people uncomfortable. They said things nobody wanted to hear. They were also usually right.